Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Is the Federal Reserve playing possum with the market? We'll talk about that. On the economic front this week, on the negative side, retail sales fell more than expected and consumer sentiment dropped to a pandemic-era low. On the positive side, however, U.S. manufacturing rose more than expected and jobless claims had a significant drop. So what do these mixed economic signals mean? Let's take a look at the charts. At the time of this recording, it is Sunday morning, so the futures market is closed. Real quick update from last week's recording. We didn't quite make that 25,000 subscriber mark, but came awful close. So please hit the subscribe button in this video, because as soon as we hit that 25,000 mark, we will give away those 5 subscriptions to our full alert service. All you have to do to become registered is pick who you might think is one of my top 3 PGA Tour players. All right, taking a look at the charts, last week we talked about this ascending pennant pattern, and the market looked like it was going to break to the upside, but then actually broke lower. Well, normally when you have one of these breakout patterns, the breakout is around the same distance as the width of the mouth of the triangle, pennant, whatever. In this case, it didn't. In fact, when we look at the moving averages, we didn't even come down to the 50-day moving average, which is where we've tested on all the previous corrections, if you want to call them that, in the market. So we stopped just short of that and actually recovered to close above the 10-day moving average on Friday's close. One good thing about last week is that when we take a look at the volume did increase. We had 5 straight days of average or above average volume. And in addition to that, we had better intraday volatility. These little tiny bars can be frustrating, but it was good to see some volatility return back to the market. I thought I would go ahead and update you on that standard deviation channel that I showed you a couple of weeks ago, and you can see that even with the move, even though it felt like maybe we had a bit of a dip last week, we didn't get too far away from the midline on the standard deviation channel. So we're right in the middle of that, still open to move a decent distance either way without violating that trend channel. And then I also thought I would bring in the weekly chart again, as you can see where that 460 level is on the extension of the 3-wave zigzag pattern, or the zigzag pattern within the 3-wave, I should say. And you can look and see that we have a doji here. Now, when we look at past weekly dojis, they've been followed mostly by upward moves. So could that propel us to that 460 level? Well, before we get there, I also thought I would remind you of this extension on the zigzag that we had within the wave 5. We talked about that in the past, which gave us the 426 level. The 261.8% extension is 452. So we have a couple fib levels here, moving up to 452 and then up to 460. In the intro, I asked if the Federal Reserve was playing possum in the market. And what I meant by that is in last month's meeting, when Chairman Powell had his press conference afterwards, he acted like they weren't even considering starting the tapering process. But then when the minutes were released last week, turns out that several of the voting FOMC committee members actually favor a tapering this year. The Federal Reserve does that a lot, where they try to sneak the news out, in other words, not to cause a shock to the market in a more significant correction. So let's take a look at the 10-year chart here, which illustrates interest rates, and you can see with this symmetrical triangle, it's like, even the bond market isn't sure. Where do we go from here? What's the Federal Reserve going to do? Personally, I think that what happens with these triangles within the treasuries is going to have a lot to do with where the market goes from here. Illustrated the mixed economic news in the intro as well. One of the things that the Federal Reserve likes to look at is slack. In other words, they look at the cap utilization within that manufacturing number to see how well companies are utilizing what they're producing. And it was a little below average, about 3% below average, which means there's a little room there. So if the Federal Reserve doesn't want to start raising rates yet, they don't have to, but where do we go from here? Depends on who you believe, whether you believe Chairman Powell or some of the voting members. And I also thought I'd bring up TBT. We haven't looked at that one in a while, so we're looking at the 10, 30, and the 20. Not a symmetrical triangle. It's nice to see the 10 and 30 in conjunction there, but still a triangle pattern nonetheless. So be watching this week to see where the Treasury market goes, where interest rates go. That's going to tell a lot as far as the next move in the markets, in my opinion. Wow, take a look at the dollar. The dollar remains really strong. Remember the zigzag we showed you? Look where we went. We were just a hair below that 61.8% extension. If you look at the correction, we had a mono B-wave correction right around that 38.2% level, which normally gives you a 61.8% extension. As I said, we're almost there. In the C wave, we have a complex wave with a zigzag within the C wave, and we touched the bottom of the wave 5 tap box, labeling the wave 5, indicating that that could possibly be the end of it, but we could continue moving up from here. Fully expect to see that 61.8% level touched on the dollar. The reason the dollar is so important being strong was all this liquidity, and now they're talking about injecting more global liquidity. It's important, in my opinion, this is just my opinion, for the US dollar to stay strong. Because if it's not the harbor of last resort, the currency of last resort, with all of this excess liquidity that we're just printing out of thin air, we get a collapse of the dollar, then we have some real problems economically here in the United States, which would translate globally as well. So that's why I'm watching the dollar so close these days. Thought we would take a look at the financial sector because we had asked, is that going to be the new leadership? The Qs are taking a break, so could this be the new leadership out of the market? And we looked at this chart, and when you look at the DMI, you can see that, wow, the ADX has crossed nicely above the negative directional indicator. We've got good separation between the two directional indicators. However, the key here is the ADX has to break above 20. And if you look out on the internet, they'll say 25 on the DMI. I'm a touch more aggressive, and I've talked about the reasons why in the past there with our other indicators and Elliott wave, etc. So I'm comfortable using a break above 20, but it has to actually break above 20. And you can look at this setup with the DMI and say, come on, it's going to get there. Just give it another day or two. But take a look at what's happened since last week. As we move forward, you can see even though it looked like clearly the ADX was going to break above 20, it didn't. That's why those indicators have to actually touch those levels. So it's important that you let them trigger for your entries. Don't just assume that it's going to get there. I talk to our subscribers about that all the time. Taking a look at the chart of Bitcoin, you can see that it has continued to move to the upside, and this zigzag that we started has reached the 100% extension. Now we consolidated right underneath that 61.8% level. So for further clarification, remember the 61.8% level was an extension level as Bitcoin was going down in the C wave of its zigzag to the downside. But on this recovery, breaking from that descending triangle, we've talked about that numerous times. We created a zigzag coming out of it. Nice consolidation there. And look, it's also right on top of that 61.8% level. And if you're looking for consolidation for an extended move in the C wave, that's exactly how you want it to play out. So we're touching that C wave extension right at 100%. At the time of this recording, Bitcoin is backed off just a touch, but not a whole lot. We're trading right between the 61.8% level and that 100% extension to the upside. So where does Bitcoin go from here? Well, the next level would be if we break above this 100% extension, get to 50,000, we might have a little road bump here at the 38.2% extension level back to the downside in that C wave. But then we would likely go to 161.8% extension here on the C wave of the upward zigzag. Taking a look at the DMI, you can see that ADX is rising, indicating that there's strength to this move. And boy, if we could get that positive directional indicator back above that ADX, man, Bitcoin could really take a run and likely go back and test its all-time highs. Finishing off as we always do with the VIX, we talked about, yikes, in this descending triangle, if we were to break out of that, man, we could have some serious volatility, which would mean a pretty significant move to the downside in the markets, and we tried last week. Look at this, 2 days in a row, we broke above that downtrend line, but neither day did we close above that downtrend line, and in fact, we technically kept this pattern of just barely, but kept that pattern of lower highs intact. And now we look and see that since we're back down here at this point of the triangle and above that support level at 16, Perhaps we go sideways for a couple more weeks, maybe into September, and really consolidate towards the point of that triangle, yielding a setup for another potential breakout attempt. Hope you found this informative. Look forward to talking to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.